Good afternoon, everyone. Welcome to our second online lecture on this topic. I'm just waiting for a few more students to join, and then we will begin. I'm just going to launch a poll. I'd like you to let me know if you can hear me clearly. Can you see the slides? Thank you so much. Can I ask that you ensure that you are muted and you can switch your videos off if they are on so that you save some data? Before we begin, just some notices about the week ahead. On Wednesday, you will have tutorial 2, and that will be online as well. So you will need your graded questions textbook for that session. And I would ask that you please check your emails for an email from your tutor, who should have provided you with the Zoom link to your tutorial this week. Most of our tutors sent that out on Friday already. So if you've not received a link from your tutor, please email your tutor, and your tutor will send you the Zoom link for this Wednesday. Tutorial 3 submissions will open on Friday, the 18th of August, and they will close on Monday, the 21st of August. You can find the questions on the Learn page. There are 2 questions for this week. The first question is a past test question, a past test 1 question, and the second question is 26.8, which is a question from your question book. If you are attempting your SAGE project and if you have any queries, please email myself or Kerry. Our email addresses are up on the screen. Remember, your deadline is the 31st of August. Please don't leave it to that last week. You should be accessing your ebook and going through the ebook, completing your training before you attempt the multiple choice assessment. You are able to consult via Zoom with your academic development officers. Please email them for an appointment and they will send you a Zoom link so that if you have any questions, I know it is very difficult now that we are online. It's difficult to concentrate. Some students have network issues or connectivity issues. And if you want to consult and clear up any of your queries, you're welcome on Westville to contact Natalie, and in Maritzburg, Sibonello. I've got their email addresses up on my screen, and you can consult with them, set up an appointment, and they will send you a Zoom link, and hopefully that will help you in this new online environment that we have. I did receive a few emails from students querying fake news that was distributed this morning about our assessments and our tests and exams going online. I have been told that that is fake news. The university has not communicated to us as yet. So I know as much as you know with regards to assessments and tests. We have not been told that assessments and tests will be online as yet. So please only take heed of an email that you get from the university. Please don't, we will not communicate to you via WhatsApp or send you an announcement on social media. You need to check your email from UKZN and they will send out an official university communication in that regard. So what is the plan for this week then? For the last 2 weeks, we've covered changes in estimates and corrections of errors. We've done that. We've completed that last week on Friday. This week, we are going to be covering changes in accounting policies. So we are still in our IAS 8 standard. And if you're following with me in your textbooks, we will be right at the beginning of chapter 26. So you should be on page 1200 in your Gripping Gap textbook. So we're now starting at the beginning of the chapter, and we're going to cover changes in accounting policies. So what are the learning outcomes for this week? What should we be able to do by the end of this week? Number one, we need to be able to define an accounting policy. We must be able to explain or discuss how to select them. We need to know how to develop them. So if the standards don't provide us with guidance on what accounting policy is available, and we have a transaction that's not covered by our standards, we need to be able to develop our own accounting policy if necessary. So how do we go about doing that? What do we need to take into consideration? Next, we need to know how to account for a change in accounting policy. So that means we need to know how to prepare a journal entry. So how do we make an adjustment for this change in the accounting policy? And lastly, we need to know how to disclose a change in accounting policy. So what does a change in accounting policy note look like? And how will this appear on our annual financial statements, on our statement of comprehensive income, our statement of financial position, as well as any notes to our financial statements? So that is what we hope to achieve by the end of this week. So firstly, how do we define an accounting policy? What is an accounting policy? The standard says to us that it is the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting our financial statements. So it is the basis and the rules that we use when we are preparing and presenting our financial statements. This is different to another type of policy you may have come across. So for example, an insurance policy is not the same as an accounting policy. Or you may have a policy of, your textbook says donating or making charity. At the end of every month, you donate to an organization. That is different to an accounting policy. An accounting policy is the rules that have been set out in our standards, and it is the practices that are used by the entity. Very important is the last point on my slide, which says that we need consistent application to ensure comparability. So here I'm taking you back to your conceptual framework, to our qualitative characteristics. Our financial statements have to be comparable from one year to another year. They also need to be comparable when we compare one entity to another entity. And the only way that we can ensure that our financial statements are comparable is, firstly, we have to apply EFFSC, so the same set of accounting standards. And secondly, we have to apply our accounting policies consistently. So do we have a choice of policy then? Firstly, if there is a policy that's prescribed by EFFSC, we must comply with the requirements of our EFFSC standards. However, if we have a transaction where we cannot find a policy, then we would need to develop a suitable accounting policy. So when I say we would need to develop a suitable accounting policy, who am I referring to? I'm referring to the management of the entity. So you as the accountant or the financial director or the CEO of this organization that you are accounting for will need to develop a suitable accounting policy. So when do we need to do that? If we have a transaction for which there is no standard applicable, So we don't have any guidance from EFFSC. So I have not come across this in practice except once, and this was when I worked at Toyota in Prospecton in Durban. And Toyota was receiving a government grant in order for them to install new production lines in the factory. And at that stage, we did not have a standard for government grants. Now we do. So we had to develop our own policy in finance that would be suitable for us to account for these government grants that Toyota was receiving as an incentive to build these production lines for the new vehicle that was coming in. And back then, it was the first time that we were producing the Fortuner in South Africa. So Toyota was receiving a government grant, and we did not have a suitable policy. So that is the only time in my experience that I've come across where we did not find a policy in the EFFSC and we had to develop our own. Okay, so how do we go about doing that, and what do we need to consider? We always need to go back to the basis of our EFFSC standards. We go back to our conceptual framework, and we go in particular back to our qualitative characteristics, because we need to ensure that whatever policy we choose, that we are still in compliance with our conceptual framework. Firstly, we need to ask ourselves, is the treatment going to ensure that we have relevance? What does relevance mean? Can you tell me in the chat what you think relevance means? What does relevant mean? Well done. Well done, Akona. Yes, Andile, well done. Michelle, yes, well done. Okay, so we've got some really good answers. So Akona says it's material. It can affect the user's decision. And then we've got Michelle says it impacts the decision made by the users of the financial statements. Then we've got it's impactful to the entity, and it provides valuable information to stakeholders. It's predictive, confirmative, well done. All of you are correct, okay? Relevance in simple English means that it's going to make a difference to the decision that the users make when they are relying on our financial statements. So yes, we need to ask ourselves, is this item material? Because if it is material, it means that its omission or its misstatement is going to affect the decision made by the users based on our financial statement. So well done, everyone. Then we need to ensure that the information that we provide is reliable. So in our conceptual framework, there were a number of sub-qualitative characteristics under reliability. Okay, is there faithful representation for our performance, for our position at the end of the year, for our cash flows? Substance over legal form is what we always account for. We saw that when we did leases last semester. We need to be neutral. That means the information needs to be free of any bias. We need to be prudent, meaning that we can't overstate any income or assets, and we can't understate any liabilities and expenses. And very important, our information needs to be complete in terms of the transaction that we have, in terms of materiality and cost. That information that we provide must be complete. Now, we need to apply our judgment when trying to apply a policy, or to understand the policy and then apply the policy. So professional judgment is needed, and we need to use the professional judgment of management, and if need be, we can also involve the use of an expert that deals with such transactions. And then lastly, consistency, which we've already mentioned. In order for us to be consistent and provide consistent information, that is going to ensure comparability of the information that we provide. If we are not consistent, then our information is not comparable. Okay, what does consistency mean? What does consistency mean? If we are consistent, what does that mean? What does consistency mean? Can you tell me in our chat? What do you understand when I say we are going to treat an item consistently? Well done, Zinhle. What we do in 1 year, we do for the same with regards to reporting. We follow the same rules. Well done. We follow the same rules and patterns and presentation as other. Well done, Simon. Okay, so you're doing it the same way. So if you're doing it the same way and you're applying the same rules every year, then you are going to be comparable when you compare 1 year to the next. Can you tell me in the chat, we studied a number of asset standards in first semester. We studied PPE, investment property, intangible assets. Then we went on to impairment, and then we looked at revenue and inventory, and thereafter leases. Can you think of any policies that we applied when we looked at those standards? Can you give me an example of a policy that is contained in the standards that we covered in first semester? Well done, Nakia. Kyron, well done. So I've got cost and fair value model. I've got cost and revaluation model. Fair value. Okay, great. So I've got some good answers. The cost model for PPE versus the revaluation model. Then we had the cost model versus the fair value model for investment property. For intangible asset, we had the cost model versus the revaluation model. And then for inventory, we had all our inventory policies that we could use. FIFO or the weighted average method, for example. So those are just some examples of the policies that we use, the rules and bases that we learned in semester 1 for the different standards that we covered. Now we're moving on to, we may need to change our accounting policy. Now this is very, very rare. And I've only come across it once, a very long time ago. So accounting policies very rarely change. Okay, there's only 2 possible reasons that there could be a change. Firstly, if it's required by EFFSC, so that would mean that your standard has changed. You've got a new standard that you are applying for the first time. The old standard is done away with and a brand new standard is being issued. So an example of that would be when we had an old revenue standard, and then quite recently we had a new revenue standard that came about. The second instance for us changing our accounting policy would be when we voluntarily decide to change our accounting policy because we believe it's going to result in more reliable or relevant presentation. So there has to be a reason for you to want to change, a very good reason. So because it happens so rarely, and because we have to be consistent and we have to ensure comparability, if we do decide to change our accounting policy, there is substantial disclosure that is needed. And there's a long list that appears in your textbook. And it starts at the bottom of page 1205 and it ends on page 1206. So that is the disclosure that we need to prepare. How do we treat this for accounting purposes? We first need to look at what is the reason for the change. What is the reason for the change? So the standard says, if it's the first time that you are applying IFRS, so it's a new standard, it's the first time that the standard has come about, it's now applicable, and we have to comply with the standard. Usually when the IASB issues a new accounting standard, they provide us with what is known as a transitional provision. What does transition mean? Transition means you're moving from one to another. So there's a change that is happening. So a transitional provision is the rules that the IASB, the International Accounting Standards Board, provides us with in order for us to move from one set of standards to a new set of standards. So they provide us with the rules that we need to apply in the meantime as we are phasing in the new standard. So that is what a transitional provision is. Sometimes no transitional provision is provided. And we need to know then, what do we do? The second instance is where we voluntarily decide to change our accounting policy. So I'm going to share with you the last page of our handout that we used in the last 2 weeks, where I've got a diagram for you here on what are the two instances when we change our accounting policy. So the first instance is if we decide to voluntarily change our accounting policy. So we ourselves decide that we want to change the policy because we believe that the new policy is going to give us more reliable and relevant information. Then we are going to go down, and we're going to use IAS 8. So we're going to use the IAS 8 rules. That is the standard that we are going to use. So the change in accounting policy then will be accounted for using IAS 8. And very important are those words, it needs to be applied retrospectively. So that is the one option where we voluntarily decide to change. The second option is where there is now a new standard that is published. So we need to do away with the old standard. So on initial application of this new IFRS standard, we have two options. Firstly, there are transitional provisions that are furnished. So the Accounting Standards Board provides us with the rules that we need to use to phase in this new standard, or they can simply provide us with no transitional provisions. If there are no transitional provisions that are furnished to us, then we can go with the guidance that is in IAS 8. But if we are given transitional provisions, we have to use the transitional provisions. So what I want you to take from the slide is to understand that where we are applying a standard for the first time, and if the International Accounting Standards Board gives us a transitional provision, this transitional provision overrides, it trumps the IAS 8 standard. We have to use the transitional provisions that are given to us. So if we go down then on our diagram and look at where these arrows are leading to, If transitional provisions are furnished, then we have to use the transitional provision. However, if no transitional provisions are furnished, we simply use IAS 8. So this diagram is then going to help you decide which provision to use. You have two options. You can either use a transitional provision if you have it. If you don't, then you have to use IAS 8. Okay, so that is how we account for a change in accounting policy. The standard IAS 8 says we have to use retrospective application. Now, we studied this when we did correction of errors last week. What does retrospective application mean? It means that we have to apply this new policy as if that policy had always been applied, meaning that we have to look at our current and our prior year figures and decide how would our prior year figures have changed if we had the new policy from the outset. So when we look at retrospective application, we are going to make adjustments to the current year as well as the prior year. But we know that when we say we make adjustments to the prior year, those books have already been closed off. Those financial statements have already been published. So we cannot go back into the past and change our prior year figures. What can we change? We can change the opening balances of the current year. So when we say retrospective application means it impacts our prior year figures, what do we mean by that? We mean that we are actually going to adjust the opening balances of the current year. So I want you to turn to page 1204 of your textbook, and we're going to look at example 1 in your textbook. Example 1 says, during 20X7, a revised IFRS on borrowing costs was published. Previously, borrowing costs were expensed, but with the revised IFRS, it now requires that all borrowing costs must be capitalized to the related asset. So what is a borrowing cost? If we borrow funds, we are going to pay interest on those funds. Interest is an example of a borrowing cost. So previously, we would have expensed those borrowing costs. Now, with the new IFRS, we are required to capitalize that interest to the cost of the related asset. Borrowing costs are incurred on all construction of plant, and we are told that the revised, meaning the new IFRS, provided transitional provisions that allowed the company to capitalize the costs from the years beginning on or after 20X8 or before this date, if preferable. So that is very standard wording that we find when we have a new standard. When a new standard is published, we usually are told that we can start applying it before the effective date if it is preferred. So the example is continued then, and we are told that the entity chooses to capitalize the borrowing costs from the earliest date possible. So they don't want to apply the new standard from 20X8. They want to go back from the earliest date possible and capitalize their borrowing costs. We are then told that the plant is not yet complete or not ready for use. What does that mean, and what does that affect? What does that bring to your mind? These words. The plant is not complete and it's not ready for use. When you see that in a question, what does that mean to you? Very good. It affects our depreciation. We can't depreciate this plant because it's not yet available for use. Well done, everyone. So we are then given information for 3 years. 3 years of information is given to us. We've got information for the year X5, X6, and X7. So the earliest date possible is the X5 year. And we are told in terms of the old policy, the interest expense was 15,000, 17,000, and 9,000 in the current year, the X7 year. In terms of the new policy, you will notice that your question says there's nil, there's no interest. Why is there no interest? Because this interest will not appear on your statement of comprehensive income. It will now form part of the cost of your asset. So it will be capitalized, it will be added to the cost of your asset. So this is the information that's been given to us. We are also told there's no other components of comprehensive income. The tax rate was 30%. And we are told that the interest incurred in each of the years of assessment was claimed as a deduction in terms of the country's tax legislation. So when you see that, what should that bring to mind? If your interest was allowed as a tax deduction, but for accounting purposes, we are going to capitalize this to the cost of our asset. Straight away, I know that my accounting treatment is different to my tax treatment. And that means I'm going to have deferred tax. For accounting purposes, we are adding this interest to the cost of our asset, whereas for tax purposes, we are subtracting interest on our tax comp as a deduction. Okay, so I want you to look at your solution on page 1204 of your textbook. And we're going to look at the solution to this question. And we're going to do each year at a time. So the first year we're going to look at is 20X5. So this slide that I've got up is broken into two parts. The first half of the slide gives you the journal entries as if we could pretend that we could go back into 20X5. Okay, what would our journal entries be? Our journal entry, first of all, is we need to capitalize the cost of this interest to our plant, which is our asset. So you'll see we're debiting plant with 15,000 and we are reducing our interest. We're crediting our interest expense with 15,000. And then because we are increasing the value of our carrying amount, it means that we're going to have a greater deferred tax liability in future because we're going to have more tax payable in future because we'll be adding back more depreciation. So we will credit deferred tax with 30% and we will debit our tax expense for 4.5. But if we look at the slide, we can see that we can't pretend that we can go back into the year 20X5 because this year's financial statements have been published. These books have been closed. So two parts of this journal entry, crediting our interest expense and debiting our tax expense is incorrect. Where have our expense items been closed off to in the 20X5 year? Well done, retained earnings, that's correct. So instead of crediting interest expense and debiting our tax expense, what we need to do instead is to, and I've repeated the journal entry here at the bottom, when we debit plant, we don't credit interest expense, but we credit retained earnings. And instead of debiting our tax expense, we debit retained earnings once again. So whenever we are processing any journals to a prior year, so in our example, our prior year is 20X5. That is before the current year, 20X7. We cannot process any adjustments to income and expenses. We have to process our adjustments to retained earnings. Okay, any questions before we move on to the next year? Okay, one question is, why do we have a greater deferred tax liability? If you think of your deferred tax computation, so if you think of your columns that you prepare when you are preparing a deferred tax computation, and if you populate those columns with the value of the plant that we now have and compare it to what we did have, then you will see that we are going to have a deferred tax liability. Because we are increasing the value of our plant by 15,000, our carrying amount is going to be greater than our tax base. And what do we do on our deferred tax comp? We take our tax base and we subtract our plant. That's going to give us a greater taxable temporary difference. Therefore, we're going to have a greater deferred tax liability. Okay. If you're feeling a bit rusty on deferred tax and you're not understanding whether it's a deferred tax asset or a liability, I have uploaded our videos for deferred tax and for current tax onto our Learn page. So if you scroll right to the bottom of our Learn page, you will find those videos on the page. They are not long videos, they are short videos based on different topics within deferred tax and a current tax. So if you need a refresher, you can go and watch those videos. Any other questions? Please explain why retained earnings. Okay, so in 20X5, this is a prior year, those financial statements have already been published and our expense and our income items have been closed off to retained earnings. We no longer have those accounts open. That is why we need to credit retained earnings instead of our interest expense, and we debit retained earnings instead of our tax expense. Let's move on to our next year then. The next year is 20X6. This is also before the current year. And we were told in the year 20X6, we had 17,000 worth of interest. So we need to now capitalize that interest expense. We're not going to have it on our statement of comprehensive income anymore. We need to add it to the cost of our asset. So in order to do that, we need to debit then our plant with the value of 17,000, and we need to get rid of our interest expense, and we would credit that account with 17,000. The same applies again. We are increasing our carrying amount by 17,000, which means we'll have a bigger taxable temporary difference, and therefore we'll have a greater deferred tax liability. Liabilities go up on the credit side, which means we will have to credit our deferred tax liability account in order to account for 30% of the 17,000 that we are now capitalizing to our plant. We cannot credit our interest expense and our tax expense. Those accounts have been closed off to the retained earnings account. Therefore, our journal entry, the correct journal entry then, is going to be to debit our plant with the interest cost, but instead of crediting interest, we credit retained earnings. And we credit our deferred tax liability because it's increasing. And the contra account will not be our tax expense, but retained earnings instead. Okay, any questions then? On the 20X6 year? Okay, Tulani says, for this example, the tax base is 0. That is correct, Tulani. The reason why the tax base is 0 is because for tax purposes, we don't have this value of 17,000 Rand as our value of our plant. That 17,000 has been taken as a deduction on our tax computation. It's not considered to be an asset by the receiver of revenue. Okay. Then I want us to move on to what is the journal entry that we should have. So I want you to follow with me in your textbooks on page 1205, and we are going to put these two slides together. So we're going to put together the 20X5 and the 20X6 into 1 year, one journal entry. And why do I want to do that? Why do I want to do that? Because remember when we did the correction of errors, we said when we are correcting opening balances, we always correct opening balances on the first day of the first month of the current year. And our current year in this example is the X7 year. So to correct our opening balances, we'll need to combine our journal entries for 20X5 and 20X6. So if I go back then to my previous slide, 20X5, we added 15,000 to our asset. And if we go to the 20X6 here, we added 17,000 to our asset. So if we combine these two journal entries then, on the first day of the first month in the current year, you'll see we are debiting plant with 32,000. How do we get 32,000? We will add the 15,000 plus the 17,000 from 2005 and 2006. So we will prepare this as one journal entry to correct all our opening balances. And very important, that journal entry has to take place on the 1st of the first X7. This does not appear in your textbook, this date. Please, can you write this date into your textbook for this journal entry that appears on page 1205? It's about in the middle of that gray block on page 1205. So page 1205. Here on page 1205, I would like you to write in this date for this journal entry here. This journal entry would be on the 1st of the 1st, 20X7. Okay, that would be your journal entry for your date for that journal entry. And that's very important because what does it mean here for this journal entry? What are we doing? Here we are correcting our opening balances. So this is the correcting journal for your opening balances. What are the opening balances or opening years that I'm referring to? We are making the correction for the X5 year and the X6 year as one single journal entry. Okay, so that is what I want you to add then to your textbook on page 1205. Okay, the second thing I want you to add to this example in your textbook is if you scroll down to the bottom of this gray block, I want you to scratch out the journal entry at the bottom two journal entries. So these two journal entries, it's been duplicated in your textbook. It's not needed. The author made a typo So please make sure you strike off those 2 journal entries at the bottom of example 1 on page 1205. Okay, now that you've scratched off that journal, we can now look at, well, what is the journal then going to be for the current year? So the journal entry for the current year will take place here, and that journal entry will be on the 31st of the 12th, 20x7. Please write that into your example. And you'll see in 20x7, they have debited the plant cost, and they can now credit the interest expense, not retained earnings. Because we are in the current year, that interest expense was not yet closed off to retained earnings. So we can still process journal entries to our expenses in the current year. So we will credit interest expense and we will debit plant cost. And then we will increase our deferred tax liability, and we will debit now our tax expense, not retained earnings. Okay, any questions? Okay, Zinhle asks, the solution is therefore where there are 2 years combined at the 1st of the 1st, 20x7. Yes, that is correct. So you don't include the previous journals. Okay, what are the journals? What is the solution that you need to provide? What is the solution that you need to provide? So the other journals that the author has given you are unnecessary. So the only journals you need to provide are these ones. I'm going to try and draw a block around them. Those are the only journals that you require. You don't require any other journals. This is your solution. It's only what is in this rectangle that I've got up here on my slide. That is your solution. So if I scroll up and look at the journal entries that she's provided in 20x5 and 20x6, we know we can't go into 20x5 and 20x6. She's only providing it to you as if you could pretend that you were in those periods, okay? But the solution is what I've got up in my rectangle on this slide. Okay, so make sure that you note that in your textbook. This is the only journal entries that you need to prepare then for example 1, what I've got in my red rectangle there. Okay, so what you could do is you could take a pencil. I wouldn't strike it off completely, because what the author is trying to tell you up here is if you could go back into the 20x5 and the 20x6 year, what would the journal entries be? But we know we cannot process any journals to the 20x6 or the 20x5 year. Those financial statements have been published. So we can only process journals then in the 20x7 year. We can't process journals in any other year. So to correct the opening balances, what do? We process these journal entries, which are there to correct our opening balances. So once again, that journal entry will take place on the 1st of the 1st, X7, and it's also a journal entry to correct your opening balances. Just remember that. Okay. Any questions? Okay, Landeka, you want me to repeat where we said we made 2 green ticks next to the journals? Okay, so the 2 green ticks that I made next to the journals is here under retained earnings. we are now, instead of processing adjustments to our expenses, we are going to process the adjustments to our retained earnings account. So if I can share then my slides, which I think you're referring to, and we look at 20x5 and 20x6, we need to process these journals in the current year on the first day of the first month. And the two ticks that I made was, instead of crediting interest expense, we credit retained earnings. And instead of debiting income tax expense, we debit retained earnings. Okay, that brings us to the end of our journal entries for example 1. Now, example 2 takes you through the disclosure requirements for example 1. Okay. So when we are looking at an example like this, how are we going to tackle example 2? And this is what I want you to follow. This is a method I want you to follow, even when you are preparing adjustments for your correction of errors. Okay. After your journal entries, what do? Remember, when you prepare journal entries, you prepare workings and you reference those workings. So what do you do thereafter? You're going to complete your note. You're going to complete then your statement of comprehensive income. Thereafter, your statement of changes in equity, and then your statement of financial position. Okay, so the disclosure list is given to you on page 1205 and 1206. Very important is, instead of using the word restated like we used previously for correction of errors, the disclosure is exactly the same, except that there's an extra comparative year for the statement of financial position. And instead of using the word restated, for changes in accounting policies, we use the word adjusted. Okay. This will appear on the top of the prior year columns on your statement of comprehensive income and your statement of financial position. On your statement of changes in equity, you'll have 3 line items. Instead of restated, you'll have the word adjusted. Then you'll tell the user, this is the balance that I previously reported, and this is now my change in my accounting policy. Please note that when I'm referring to the statement of changes in equity, I am referring to the column retained earnings in your statement of changes in equity. Okay, I'm now going to share with you example 2 from your textbook. So I'd like you to follow with me, and we're going to make some notes. I can see we're going a little bit over time, but I am recording so that you can, if you do need to go off to another lecture, you're welcome to do so, but I am recording so that we can continue and look at the disclosure, which I think is very important for this example. So in example 2, you are given some balances. You were given the statement of financial position, and you're given a draft statement of comprehensive income. And then we have to complete the note, and we have to complete our financial statements as well. So if we look at the note, first of all, and I'm going to focus on the change in accounting policy note, what do I want you to take note of first of all? Number 1 is this bit, which is a narrative. Okay, that is your story where you are telling the users of the financial statements what policy you've changed and why you have changed it. You are also telling them from which date have you decided to change it. So you're saying the change in accounting policy was a change from expensing our borrowing costs to capitalizing those borrowing costs. And then you're telling them, why was the change made? Was it the initial application of an EFFSC standard, or is it a voluntary change? In this instance, we had a new EFFSC called IAS 23. So we are doing it to comply with this new IAS 23 standard. And then we are also telling them that we have decided to apply this from the earliest date possible. Okay, so what we need to take note of is the format of the note. What does it look like to you? It should be very familiar to you, because this is exactly what we've covered last week when we did correction of errors. Except that now you've got the years, 2 years for the statement of comprehensive income, and then you've got 3 years for the effect on the statement of financial position. Now, all of a sudden, you have this 20x7 year, you have the current year on the effect on the statement of financial position. You've got one additional year that you are disclosing now in your change in accounting policy. Okay, so please take note of that. Okay, the signage and the working of the note is exactly the same. And all of these amounts come from the journal entry, 17 and the tax, 9 and the tax. Those come straight off your journal entries. Very important is the signage. We follow the same signage as we did with our correction of error note. Increases and decreases in assets and expenses are accounted for in the same way, whereas increases and decreases in income and our liabilities and equity items are accounted for in the same way. So ensure that your signage is always correct. If your signage is incorrect, then you will get 0 marks. So please learn the signage on the note. It is very important, because you can do all the workings and get to the correct amount. But if you say it's an increase instead of a decrease, then it means your answer is wrong. So signage is not something you want to get wrong after doing all your workings. Please learn the format of the signage that is in your textbook so that you can be consistent. Okay. Then I want to go on to your other standards, I beg your pardon, your other financial statements. On your statement of financial position, you've got the word adjusted for 20x5 and 20x6. So you've got 2 years of comparatives and you have the word adjusted. Straight away, when a user looks at financial statements and it has the words adjusted at the top of the column, they know that there's been a change in accounting policy, and we know that these columns are going to include the affected adjusted amounts. So it affects the prior year. Okay. Note that the current year doesn't have the word adjusted. Because the current year hasn't been published as yet, there's no adjustment that we have to make for the current year column. Okay, so the prior year columns have the word adjusted. Please note that in your textbook. If we move down then to your statement of comprehensive income, in your retained earnings column, that is the column we're going to look at, we're going to have 3 words, 3 sets of terminology that we should see on our statement of changes in equity. Number 1, our opening balance has the words adjusted. Okay, there's 2 years that appear on our statement of changes in equity. It's the X6 year and the X7 year. So it's the current year plus 1 comparative year. So it always starts off on the first day of your comparative year, and you have to have the words adjusted. Then we're going to say to the users, this is what I previously reported to you. So if they had to pick up the financial statements for 20x6 and they looked at the opening balances, this is the amount that we would have told them that our opening retained earnings would have been. But now we've had a change in accounting policy. And the effect of the change in accounting policy is that we've had an increase in retained earnings of 10.5. And that means that our new opening retained earnings would be 130,500. The total comprehensive income for the X6 year was adjusted, so the closing balance was adjusted as well. So we'd have to tell them previously reported at the end of the X6 year, we had retained earnings of 500,000, but because we've had a change in accounting policy of 22,400, this means our new retained earnings is 522,400. Okay. Then I want you to take note here on your current year's total comprehensive income. You don't have the words adjusted. The reason for that is because we are in the current year, our current year financial statements have not yet been published. So we are not adjusting anything in the current year. We are simply presenting our current year's total comprehensive income as it is. So therefore, it does not have the words adjusted as we've had for the 20X6 year. Okay, any questions? Okay, and the last thing we're going to go down to is our statement of comprehensive income. And the only thing that you need to note here is in the comparative year 20X6, we've got one comparative year in our statement of comprehensive income, and we've got the word adjusted. Okay, very, very important. Okay, because that prior year has been adjusted. Okay, any questions? I'm going to leave the chat open. So those of you who want to ask questions, you're welcome to stay on and ask questions in the chat, and I will assist you. And those of you who have another lecture, you are welcome to leave. Thank you very much.